What if the biggest lie in investing wasn't a scam stock, but a strategy almost everyone blindly follows? Because for years, ordinary investors have been told the exact same thing. Just buy great companies and hold forever. Sounds smart, sounds safe, sounds responsible. But in 2026, that advice has quietly destroyed fortunes. Not because markets stopped working, not because innovation died, but because the speed of change became too violent. And most investors never adapted. See, most people still think stock market success is about finding good companies. It's not. The real game is understanding where money is moving before the crowd realizes why it's moving there. That's the difference. And once you understand that shift, you stop investing like the public and start seeing the market the way institutions do. Because let's be honest, if buying and holding forever truly worked the way Wall Street advertises it, millions of investors wouldn't still be trapped inside stocks that are down 70%, 80%, even 90%. Some people are still emotionally defending companies that erased nearly their entire portfolios. And that's the brutal part nobody talks about. The financial industry loves showing you the winners. They rarely show you the wreckage. They love showing charts that go up forever. They don't show you the investors who spent 5 years waiting for a comeback that never came. But here's where things get interesting. Because while most retail investors were stuck praying their collapsing stocks would recover, a completely different class of investors was quietly rotating into new opportunities. And those opportunities exploded. Not by 20%, not by 50%, but by hundreds of percent, sometimes in less than a year. Now, before we go any further, understand something very clearly. These weren't random lottery ticket penny stocks. These were real companies, real businesses, real macro trends, and real institutional money pouring in before the mainstream finally noticed. Take the quantum computing trade. Almost nobody believed in it. People laughed at the sector. They said it was decades away, too early, too speculative, too theoretical. But behind the scenes, money started flooding into the space anyway. And that's the part most investors completely miss. Markets don't move based on what's fully proven. They move based on where capital believes the future is heading. That's why some of those tiny quantum names exploded 500%, 800%, even over 1,000%. Not because the technology suddenly became mainstream overnight, but because smart money understood perception shifts before the crowd did. And that same pattern showed up again with Palantir. Back in 2021, most people completely misunderstood that company. The public narrative was simple. Overpriced software company, government consulting, too expensive, too weird. But underneath that surface narrative, something much bigger was developing. Palantir wasn't just selling software. It was becoming deeply integrated into defense, intelligence, AI infrastructure, and national-level decision systems. In other words, it was positioning itself as critical infrastructure for a future powered by artificial intelligence and geopolitical competition. That's not a normal software story. That's an operating system for power story. And once institutional investors started realizing that, the stock exploded, hundreds of percent higher. While most people were still arguing about quarterly earnings, that's the disconnect. Retail investors focus on headlines. Institutions focus on positioning. And that difference changes everything. Then came another opportunity almost nobody respected at first. Seagate, a hard drive company. Sounds boring, right? Exactly. That's why most people ignored it. Everyone was chasing flashy AI names. Everyone wanted the glamorous chip companies. Nobody wanted the boring infrastructure. But smart investors saw something others didn't. Artificial intelligence doesn't just need chips. It needs storage. Massive storage. Unimaginable amounts of storage. Every AI model, every training data set, every video file, every enterprise system, every cloud workload, all of it needs somewhere to live. And suddenly the boring hard drive business became one of the most important hidden beneficiaries of the AI boom. That realization changed everything. The stock went from ignored to becoming one of the market's biggest winners. And this is where the average investor gets trapped emotionally. Because once these moves become obvious, most people finally buy. Not at the beginning, not during uncertainty, but after the headlines arrive, after the excitement arrives, after social media starts screaming about the next trillion-dollar opportunity. That's usually when risk becomes highest, and it's why so many investors experience the exact same painful cycle over and over again. A stock rises, people get excited, they buy late, momentum fades, the stock collapses, and then they hold emotionally for years hoping to recover. That's not investing, that's attachment. And attachment is one of the most expensive emotions in financial markets. Because markets don't reward loyalty, they reward timing. Now this next part is critical. Most people believe stocks always recover eventually, but that's only consistently true for broad indexes like the S&P 500. Individual companies are completely different. Technology changes too fast. Consumer behavior changes too fast. Competition changes too fast. And sometimes entire business models become obsolete almost overnight. History is filled with companies that once looked unstoppable. BlackBerry, Nokia, Xerox, household names, market leaders, dominant brands. And then suddenly, they weren't. The market moved on, technology evolved, capital rotated elsewhere. That's how financial reality works. And yet millions of investors still cling to the fantasy that every stock eventually returns to glory. That fantasy has destroyed enormous amounts of wealth. Just look at what happened to some of the market's favorite hype names. PayPal was once considered the future of money, one of the strongest pandemic winners. Massive excitement, massive optimism, and then growth slowed. Competition intensified. The narrative changed. The stock collapsed. The same happened with Plug Power. People called it the future of energy. The next Tesla, hydrogen revolution, endless hype. Then reality arrived, and investors who blindly held through the collapse got devastated. BlackBerry, Lucid, NEO. The stories changed. The capital rotated out, but many retail investors never mentally adapted. They kept averaging down, kept defending the stock online, kept believing recovery was guaranteed. Meanwhile, institutions had already moved on to the next opportunity. That's the hidden truth most investors never learn. Wall Street doesn't marry stocks. Wall Street rotates. And once you understand rotation, you start seeing opportunities differently. Not based on emotions, not based on headlines, but based on money flow, macro trends, institutional positioning, and asymmetric setups before the crowd arrives. That's exactly why some of the market's biggest future winners are often hiding in places nobody is looking yet. And right now, that exact setup may already be forming again. The most dangerous moment in investing is not when everyone is afraid. It's when everyone feels safe, because that's usually the exact point where risk becomes invisible. Think about it. At the top of every major hype cycle, investors always say the same things. This company is changing the world. This stock can only go higher. You're crazy if you sell now. And then months later, those same investors are staring at portfolios that have been cut in half, or worse. The painful truth is this. Most people don't lose money because they buy bad companies. They lose money because they buy good stories too late. And once you understand that distinction, you begin to see the market completely differently, because the market is not driven purely by fundamentals. It's driven by attention cycles, capital rotation, narrative momentum, and timing. That's why a hated stock can suddenly become the biggest winner on the market, while a beloved stock quietly collapses in slow motion. Take Intel, for example. There was a time when Intel became almost a joke on Wall Street. Investors mocked it constantly. People called it dead money. They said AMD had won. They said Nvidia had permanently replaced it. The headlines were brutal. The sentiment was terrible. And that's exactly why it became interesting. Because when everybody hates the same stock, institutions start watching very carefully for signs of reversal. Not emotional reversal, financial reversal. There's a difference. Most retail investors react emotionally. Institutions react to flow. And at some point, money quietly started moving back into Intel. Not loudly, not dramatically, quietly. That's usually how major moves begin. Before headlines, before influencers, before YouTube thumbnails, before CNBC starts talking about a comeback story. Institutional capital always moves first. And once enough money begins rotating into a sector, the move can become violent. That's what happened. The stock eventually exploded higher, while most people were still emotionally anchored to old narratives. And that's one of the biggest investing lessons nobody teaches beginners. Narratives lack reality. By the time the media fully understands a move, the smart money is often already looking for the next one. That's why chasing hype becomes so dangerous. Because retail investors usually enter during peak emotional excitement, but professionals often enter during confusion. That's where asymmetric opportunities are born. Now here's the fascinating part. If you study the market carefully enough, you start noticing patterns. Not random patterns, behavioral patterns. For example, the biggest winners often start in sectors that feel uncomfortable, unpopular, ignored, or too early. Meanwhile, the biggest losers often begin as the market's favorite obsession. That's because once everyone agrees on a story, most of the upside is already priced in. And this is exactly why so many investors got destroyed in names like Lucid and NIO. At one point, those companies represented the future. Electric vehicles, massive growth, disruption, innovation. The hype was unbelievable. Social media treated those stocks like guaranteed millionaire machines. People weren't investing anymore. They were emotionally joining movements. And once investing becomes emotional tribalism, discipline disappears. That's when people stop managing risk. They stop asking questions. They stop evaluating changing conditions. They become emotionally attached to narratives instead of focused on probabilities. That's how portfolios get destroyed, because the market does not care about loyalty. The market only cares about future expectations. And when those expectations change, capital leaves fast. That's why some stocks fall 70%, 80%, even 90%. Not because investors are stupid, but because they confuse belief with strategy. And once that emotional attachment forms, people become trapped. They average down endlessly. They defend the company online. They attack anyone who disagrees. And they slowly watch years of capital evaporate. Meanwhile, institutions already rotated elsewhere months ago. That's the game most retail investors never realize they're playing. They think they're competing against other ordinary investors. They're not. They're competing against systems designed to detect shifts before public perception changes. That's why understanding macro tailwinds matters so much. Because macro trends create massive rivers of capital flow: artificial intelligence, cybersecurity, defense, energy infrastructure, semiconductors, data storage, reshoring. These themes are not random. They represent where governments, corporations, and institutions are deploying enormous amounts of money. And when enough money floods into a sector, secondary opportunities emerge everywhere around it. That's something most investors completely overlook. They focus only on the obvious winners. But often the real money is hiding one layer deeper. For example, everyone focused on Nvidia during the AI boom. Makes sense. But hidden underneath that move were dozens of companies benefiting indirectly from the exact same trend. Data centers, cooling systems, power infrastructure, storage providers, semiconductor equipment suppliers, cybersecurity firms, and those secondary plays can sometimes become even bigger percentage winners because nobody notices them early. That's where things become extremely interesting right now. Because while most retail investors are still chasing crowded AI names, a completely different set of companies may already be entering the next phase of institutional accumulation. One of those names is Fortinet. And on the surface, Fortinet doesn't sound exciting. It's a cybersecurity company. Not exactly the kind of stock that dominates social media hype cycles. But that's partly why it matters. Because cybersecurity is no longer optional. It's becoming survival infrastructure. Especially in the AI era. Think about what artificial intelligence is actually doing. It's making systems more powerful, more connected, more automated. But it's also making attacks far more dangerous. AI-generated phishing, AI deepfakes, AI malware, AI-assisted cyber warfare. Entire corporate boards are beginning to realize something terrifying. The future threat environment looks radically different from the past. And when fear enters the corporate world, budgets explode. That's exactly what's happening in cybersecurity right now. Companies are spending aggressively because the cost of being unprotected is becoming catastrophic. That creates a very powerful environment for firms positioned correctly. Now here's what makes Fortinet especially interesting. The company doesn't just sell software subscriptions. It also builds specialized hardware and proprietary chips designed specifically for cybersecurity performance. That matters enormously. Because in infrastructure businesses, performance advantages create moats. And moats attract institutional capital, especially when recurring revenue is involved. Think about it logically. A company might cancel a marketing subscription during a recession. They might cut consulting expenses. But cybersecurity, that becomes extremely difficult to remove. Once integrated into enterprise systems, those contracts become sticky, predictable, recurring. Wall Street loves predictable cash flow. And that's one reason institutional investors are paying close attention to the sector again. But here's the most important part. The stock itself had already been beaten down previously. That matters because the best opportunities often emerge when fundamentals improve, sentiment remains cautious, and institutional money quietly starts returning. That combination can create explosive setups, especially when most retail investors are still distracted somewhere else. And that's the hidden pattern repeating again and again throughout market history. The crowd looks backward. Smart money looks forward. The crowd buys certainty. Smart money buys transition. And right now, some of the most important transitions in the market may still be invisible to most people. One of the biggest misconceptions in investing is that the best opportunities always look exciting. In reality, some of the market's greatest winners start out looking unbelievably boring, not glamorous, not viral, not trending on social media, just quietly sitting there while almost nobody pays attention. And ironically, that's often where the real opportunity hides. Because when everyone is looking in one direction, massive value can build somewhere else unnoticed. That's exactly why institutional investors constantly search for out-of-favor businesses, not dying businesses. That's important. There's a difference between a broken company and a temporarily ignored company. Wall Street knows that distinction matters enormously. And one of the most overlooked setups in modern markets happens when a real business gets crushed emotionally, sentiment becomes negative, expectations collapse, but the underlying demand for the business still exists. That combination can create explosive reversals, especially when macro conditions start improving unexpectedly. And that brings us to one of the most unusual opportunities developing right now, Compass Minerals. At first glance, this company sounds almost laughably boring. Salt, fertilizer, that's it. No flashy AI branding, no futuristic robot narrative, no billionaire CEO promising to change humanity. Just physical commodities, real assets, real demand. And strangely enough, that's exactly what makes it interesting. Because markets move in cycles, and every cycle eventually creates exhaustion. Right now, investors are overloaded with software hype, AI hype, and ultra-speculative narratives. Everything feels digital, virtual, fast-moving. But underneath that excitement, another trend has quietly started emerging. The return of hard assets, physical infrastructure, physical resources, physical supply chains. That shift matters more than most people realize. Because in a world becoming increasingly unstable geopolitically, physical scarcity becomes extremely valuable. Governments understand this. Institutions understand this. Supply chain planners definitely understand this. And slowly capital starts rotating toward businesses connected to real-world necessities. Compass Minerals sits directly inside that world. The company produces salt used on roads during winter. Sounds simple, but think about it. Demand doesn't disappear. Cities still need roads functioning. Transportation systems still require maintenance. Entire regions depend on these materials every year. That creates a surprisingly durable business model. Then there's fertilizer, specifically specialty fertilizer products used for premium agriculture. Fruits, vegetables, nut production, higher margin agricultural segments. Again, not exciting headlines, but incredibly important infrastructure for food systems. And here's the key point most retail investors overlook. AI cannot replace physical resources. Artificial intelligence can optimize logistics. It can improve farming efficiency. It can automate processes, but it cannot magically create salt mines or fertilizer reserves. That physical limitation creates strategic value, especially during inflationary periods or global instability. Now combine that with another important factor. The stock had already been heavily beaten down. That's critical, because institutions rarely hunt for opportunities after 5 years of nonstop optimism. They hunt where expectations have already collapsed. And Compass Minerals went through serious pressure, debt concerns, operational issues, weather-related problems, weak investor sentiment. The market essentially gave up on the story, and that's often where the earliest stages of reversal begin forming. Because once expectations become low enough, even modest improvements can create major upside. That's one of the most important investing principles nobody teaches beginners. Stocks move based on the gap between expectations and reality, not just reality itself. A company doesn't need perfection to rally. It simply needs conditions to become less bad than feared. That's how massive reversals often begin. And once institutional investors detect improving balance sheets, stabilizing earnings, or fresh money entering a sector, they start positioning aggressively before public enthusiasm returns. That's the pattern repeating again. Not just with Compass Minerals, but across the entire market. Now, this next opportunity may actually be even more fascinating because it sits at the center of one of the most powerful technological arms races happening on Earth: semiconductors. Everybody knows the obvious names now. Nvidia, AMD, TSMC, ASML. Those companies dominate headlines constantly. But hidden underneath that ecosystem are smaller businesses the public barely understands, even though the entire industry depends on them. And that's where MKS Instruments enters the picture. Most ordinary investors have never heard of this company. But behind the scenes, MKS plays a crucial role in semiconductor manufacturing infrastructure. The company builds precision systems used inside advanced chip manufacturing equipment. Gas flow controllers, vacuum systems, laser technologies, specialized industrial tools, not flashy consumer products, but essential infrastructure. And this is where things become incredibly important. Because semiconductor manufacturing is no longer just a business trend. It's becoming a geopolitical priority. The United States wants more domestic chip production. Europe wants independence. Japan is investing heavily. India is ramping up aggressively. China is building relentlessly. Governments around the world now understand that semiconductor dominance equals strategic power, which means trillions of dollars could eventually flow into this ecosystem over time. And when that happens, secondary infrastructure suppliers can become massive hidden beneficiaries. That's why MKS becomes so interesting. The company essentially sells the tools required to build the systems that build the chips. It's a shovel supplier inside a modern technological gold rush. And historically, shovel suppliers can become incredibly powerful investments because they benefit regardless of which specific chip company dominates. Now here's the critical part. Semiconductor manufacturing is cyclical. Factory spending rises and falls. Investment waves expand and contract. That's normal, but markets care about direction. And right now, signs suggest the next expansion cycle may already be forming. Governments are pushing domestic manufacturing incentives. Corporations want supply chain security. AI demand is exploding computational requirements globally, and suddenly semiconductor infrastructure spending becomes strategically urgent. That changes the landscape dramatically, especially for companies already embedded deep inside that ecosystem. And just like the earlier examples, the opportunity became more attractive precisely because the stock wasn't at peak hype. This is the pattern most people fail to recognize. The market rewards future positioning, not backward-looking comfort. That's why the best setups often feel psychologically uncomfortable at first. Because if everyone already fully agrees on the opportunity, the easy money is usually gone. That's why institutions constantly search for misunderstood sectors, hated narratives, improving macro conditions, and early signs of capital rotation. That combination creates asymmetric opportunities. And in many cases, those opportunities appear long before the public narrative changes. Which brings us to the most important lesson of all. The greatest investors are not predicting the future perfectly. They're identifying where the probability imbalance exists before everyone else notices it. That's the edge. And once you start seeing markets through that lens, you stop chasing hype and start hunting for transitions.